one of the easiest ways that I've learned to get ahead is to really focus on the risk side of the equation, and then again get out of your own way with the reward side of the equation. It's irrelevant how much the times you'll win or lose. What matters is the size of the win compared to the size of the loss. Most people don't look at the risk side of the equation.
Last Week in the Market is now Right of the Chart, the podcast for self-guided independent traders. Hello, friends. Welcome to the podcast. I'm glad you're here. I'm Sean Vincent. I am the voice of Right of the Chart. Today we'll be talking to A.M.P.D. Sarhan. He is the brains behind Right of the Chart. Over the last month, we've heard from a couple of guests. One is Dennis Wilborn. The other is Mike Lamothe. They are both what you'd call swing traders. Swing trading is something that's very similar to A.M.P.D. Sarhan's A.M.P.D. trading strategies. It differs a little bit in the way they exit their positions and take their profits. You know, there's no one right way to make money in the market. The idea is to expose yourself to a lot of techniques and find the one that works for you. Adam doesn't like to put labels on these things, but I'm going to talk to him today a little bit about how he sees the difference between the A.M.P.D. trading strategy, swing trading, and what lessons there are for self-guided independent traders. But before we get to all of that, remember that in the market, the past does not predict the future. No results are typical, and there is inherent risk when trading in the market. This podcast is for educational purposes and does not constitute financial advice. It's August 30th, 2024, and here's what happened last week in the market. So look, the big news was that NVIDIA reported earnings on Wednesday. Things look good. Profits are up. Just the same, the market sold it off, and the QQQ SMH went down as well. Semiconductors might be overbought, and the optimism for it has just reached its peak. It's not the end of the world. There's strength in other sectors, and that's where we be putting our attention. So here's what I want to talk about here. So one thing that is in the book, and you say it all the time, is that there's certainly more than one way to make money in the market. It's all about finding the way that works for you, plays to your strengths, and plays to your understanding of how the market works. So you've introduced me to Mike Lamothe and Dennis Wilborn. They are both swing traders. And there's a lot of things that swing traders have in common with the A.M.P.D. style that you've developed and that I adhere to. But there are some other things that are different. And one thing that I thought was key about the difference is that a swing trader, they use protective stops to mitigate their losses like we do in A.M.P.D. But we close our podcast every week by saying, keep your losses small and let your winners fly. That's from you. You say, let your winners run. Swing traders will often take profits out of winning positions at periods as they go up and then leave a little bit left in at the end with some trailing stops. It's a little bit different than what we do. And I'd love for you to talk a little bit philosophically about how you settled on letting your winners fly or letting your winners run.
Yeah, this is a great question. Swing trading, everyone defines things differently. So I'm going to take the labels off, if that's okay, Sean.
Yeah, that's fine.
And I'm going to talk about the concept of stops and what are they and risk management, right? So first off, everybody comes to the market. They pull up their phone. They get their calculators out. I'm going to start hitting some numbers, kind of like George Jetson did, if you remember the old cartoon.
Oh, I do.
And, you know, here's the thing. You type in some numbers, this, times this, equals, and then ka-ching, big money. Look, I even broke the calculator. I got an error message.
Yeah.
So point is, there's two sides of every trade. There's risk, and then there's reward. People come in, if the stock's at $1, I buy 1 million shares, and it goes up to $2. I made $1 million on 10 million bucks, 200 million bucks. Reward. Okay, great. That's fine. Well, that's what we're here for. But almost nobody, especially people that aren't successful in the market, most traders don't beat the market, right? Most people don't look at the risk side of the equation. And that's why in the book, there's a whole part of the investment system, A.M.P.D, A.M.P.D. D is for defense first. And the idea there, Sean, is to always respect risk.
Yeah.
You know, Warren Buffett has 2 rules for investing. Rule number one, don't lose money. Rule number two, don't forget rule number one. Don't lose money. Well, okay, my world is risk first, defense first. If you look at the risk side of the equation, forget about the reward side of the equation for a second, the calculator and getting lost in the sauce and making all these dreamland and numbers and oh my God, blah, blah, blah. That's all nonsense. All that matters is what are you actually able to do in real time? And one of the easiest ways that I've learned to get ahead is to really focus on the risk side of the equation. And then again, get out of your own way with the reward side of the equation. So what I do is, okay, great. Before I enter, I ask myself those three magic questions, which we discussed. Where am I going to enter? Where do I exit? And how much do I risk if I'm wrong? Great. But once I'm in, then there's an entry point. There's a stop, initial stop. So let's say I'm going to lose, get in at 100. I get out at 95 if the stock drops to 95. Okay, great. So I lost 5% on that position. Well, how much of my portfolio did I lose? Right? So it all comes back to stops and risk management. Early in my early days, I didn't even think of that. And I got crushed. So I would take an 8% stop loss, do that 100% of my portfolio 3 times. I just lost 24, 25% of my money. Oh my goodness. 3 or 4 more of those and 4 or 5 of those and game over. So
and you're out. Yeah.
that's not sustainable. So quickly I adjusted and said, okay, I've got to look at the impact to my portfolio because that's what matters, my money, and protect the money like Warren Buffett says. So the initial stop is step 1. Step 2 is people have, I'm going to have a price target. I think this stock goes up 20% or 8%. I'm going to sell it. Great. So if I lose, just easy math, if I lose 1% 9 times, I'm down 9%. On my 10th trade, if I make 10%, I'm up net. Great. Or let's use $1. Forget percentages because it'll be easier with dollars. I lose $1 9 times, I'm minus 9. The 10th trade, I make $10. At the end of those 10 trades, I'm up 1, even though I lost 90% of the time. It's irrelevant how much the times you'll win or lose. What matters is the size of the win compared to the size of the loss.
How much you win when you do and how little you lose when you do. Yeah.
Very well said. So if I know most of my trades don't work, like most things in life don't work, and that's okay, as long as you keep the risk small, my goal by definition is let those winners run. Because I don't want to arbitrarily get in there and say, this thing goes up 8%, I'm out. Well, yeah, that'll help me clean up some of the losses I had and then some. Sure, that's great. But if I do that, I'm never going to be around when the stock goes up 100 or 200% or whatever the case may be. Like NVIDIA. Now, I'm full disclosure, I'm long NVIDIA. I've been long for over a year and change. And I'm up over about 200% or 175% last I checked. Was at one point, it was over 200%, depending on where the stock is and all that stuff. It's a monster win. That did way more than, let's say you lose 9 times. Instead of being up 10, you're up 200.
Yeah.
What? Like, yes, I want that all day long. So if I put an arbitrary stop at up 20% or 30% or 40%, I've done that in the past, but I've prematurely cut my winners. And I don't want to do that ever again. So because those winners, they're rare and they're few to get those monster gains. But when you get them, you really have to sit because that's where the life-changing wealth comes from. Over time, compounded out, right? I say compound, or it's not my word, but I love the term compounding is the 8th wonder of the world. And it really is marvelous when you understand it and you can use it to your advantage. So, and everything else compounds, not just money. Knowledge compounds, relationships compound, so on and so forth.
Yeah.
So, doing good compounds. And same thing with the other side of the trade too. Doing bad compounds, losing habits compound, losing trades. It's not just one cookie. It's one cookie every single day for the rest of your life after every meal, so on and so forth. Oh my God. Once I realized that, I was like, okay, well, I still want the cookie. So let me take one bite instead of the whole cookie. At least, take
right.
small steps, at least in the right direction. So, and then eventually stop. But anyway, that's another story. So the idea, Sean, is to really have a system that works for you, that allows your winners to run. And when you're wrong, be wrong small.
Yeah.
And I learned that from nature. We talked about the wind earlier. Let's talk about apple trees. You garden. There's an apple tree has thousands of seeds that come out. Most seeds fail. That's okay because you just need one and you have a beautiful new tree. And guess what? Thousands, if not millions of new seeds come out. And then that process repeats itself. When most of those seeds fail, that's okay. One more hits and then bam. So it's just a law of nature. Same with trade, same with relationships, same with most things in life. Yeah. And that's okay, providing the losses are small. When you get in trouble is when those losses are big. Yeah. And I've done that too. So learn from fool me once, shame on you, fool me twice on me. So this is one of those situations where I've made these mistakes. A wise person learns from their mistakes, or a wiser person learns from other people's
Other
mistakes.
people's
In this
mistakes.
case, I want you, everybody listening, to be the wiser person,
And
because
so,
both work, but figure out what works for you.
well, and what works for you. And here's where I can see where setting your stops for your profits would work for somebody else who has different emotional triggers. Because you just talked about Nvidia being up over 200% at one point, and then went back down to in the 145s recently. And now you're back up above 175, right?
Yep.
And what that means is that you had enough profit in it and the stomach to endure like a 25% drawdown on that thing from your unrealized profits, right? And
So
I
that's
think,
big. Yeah,
right, but I think
that's
some
big.
people would feel like they'd lost that 25%. And we've seen this happen a lot when you make emotional mistakes is you follow losses down, right? And
Yeah.
if they didn't have if then it kept going down, you had a stop loss in there somewhere, it would have triggered, you let it go, and you'd have been fine. You know, with the system that you're going to give up some at the top when it comes down. I
Yeah.
think some people can't palate that, and
Well, it's very
if you
true.
can't
Yeah, it's
palate
very,
coming
very
off the
true.
top and losing a little bit of those unrealized gains before you sell out, then putting stops in to trigger taking profit out along the way might work for you. But if you know that you have the mindset that you understand you're going to lose some at the top when it after it's reached the peak, and you're going to get the bulk of the move, and you can rely on your own decision making in the moment to do it, then you have that luxury as well.
Well, yeah. So you're absolutely right, Sean. This is one of the biggest and most underspoken or underrated or under talked about things in the world when it comes to trading, because Nvidia this is now August 24 that we're speaking, the end of August. It just fell 35%, almost 36% from 140 to 90, and from the middle of really the end of June all the way up until the beginning of August. And that's a 35% decline. That would make most people that own it vomit. Now, granted, all of that was profits for me because I'm not going against my principle. These are unrealized gains. So I had, let's say, up 220%, and I'm up now 190-ish or somewhere in that range, or 175 to 140. But the point is that they're all profits. So it's way different. I have a cushion, way different from an initial position. That's
Right.
one. Two, I've studied these big leading stocks. This is my focus. This is my area of expertise for decades. And every single one of them, Sean, that has these mind blowing rallies, guess what? Has these big double digit declines along the way multiple times, not once, not twice, but more than 3 or 4 times before they eventually top out and stop going up. So if you look at it and you look at NVIDIA, the prior base or consolidation area resistance was 97 ish, and the fell now where it didn't even break the 200-day moving average. And that day on August 5th, when it fell hard, it undercut, hit a low of 90, but closed at 100. So that old area of resistance, now you built a new base up here, became support. That's not a mistake. Just like nobody gets a six pack by accident, it's not a
Yeah.
mistake that day that support was tested and then defended. And it didn't even touch a 200-day. So for me, a guy that has a big cushion, triple digit cushion, which is very rare, but I have one, I know the stock's going to pull back 30 or 40% or even 50% at some point in time. And as long as it doesn't undercut or give me technical damage, it did break the 50-day moving average, no question. It's done that
Yeah.
before. But it didn't break the 200 and it didn't break the old chart highs. So what do I have to worry about? But going into this, it's all about expectations. I understand that that's part of the process of owning a big monster stock is sitting through several big double digit drawdowns in the stock.
Yeah.
And as long as technical damage isn't really, everyone's different. Some people don't have the stomach to do that. I didn't early in my career. I learned how to do that. But, for each their own. Look, you could easily have blown out of this when it broke the 21-day moving average and then bought it back just again recently when it got back above the 21-day and made a lot of money. Again, that works. I
Yeah.
chose not to do that. For each their own. And
Since,
that's where yeah.
since you brought that up, let's talk about that. So what you've just proposed is an alternate to taking down a 25-30% drawdown on a leading stock that you believe was going to go up, and it found support in a place where you were comfortable. The alternative to that would have been to have tight stops up there when we anticipated that things were going to turn, trigger it under the 21-day moving average, take that profit, watch it go down, watch it bounce, buy the bounce after the dip, after it reached some technical thresholds, and then profit on the way back up again. So the opportunity cost for that is, I've found that when I'm the sharpest and I'm really watching,
Yeah.
I'm going to lose 3 or 4% at the top, and I'm going to lose 3 or 4% off the bottom of the swing,
Yeah.
right? So let's just say that's 6 to 8%, and that's if it doesn't gap up above a
Yeah.
resistance like we saw recently, and then I could leave more on the table on the way back up, right? So I could
Yeah.
maybe lose 10% of the swing by trying to really tightly time a retraction like that. Plus, there's the added opportunity cost of when I get back in, now I have capital at risk again, right? It's my realized gains. I'm putting them back in, and my stop's going to be below my entry point. That's at risk again, and
Yeah.
it has to go up again before I start locking in that profit. Whereas if it's all unrealized profit and it's swinging within a wide margin of that, you have that cushion, you called it. You can decide, is it worth all the risk and the aggravation of getting out and getting back in, or do I believe this is still a bull market? This is expected behavior. I have every reason to think it's going to go back, and I can afford to absorb this as long as I know where I'm not willing to put up with it anymore. And I'm going to cash out and take my winnings and wait for the next opportunity.
Yeah, 100%. And we should wrap up on that note, because that's an important concept for people to just digest and figure out what works for them. And
Yeah.
really go back and re-listen to what Sean just said, because that's some really, really powerful stuff for people to understand. And it might be difficult to understand the first few times until you experience it. And then when you get it, because it's not easy to sit back and watch a stock go down 35% at all. And especially if you have no idea if it's going to come back. And I don't have any idea if it's going back. All I know is that, hey, I'm in this for the quote unquote long term. I've got a huge cushion, and it hasn't really broken down any kind of long term areas of support. So I'm going to hold it and give it the bullish benefit of the doubt for as long as it can. Now, I could be dead wrong, and it could gap down on me. They report earnings in a few days, and I can be out of it that day, and that's it. It's done.
Yeah.
So, or maybe it gaps up and I buy more. You don't know, but you got to figure out what works for you.
But if you'd already made the decision and you traded your plan, there's not a lot of regret when you
Correct.
know what the possibilities are, and it just didn't work out the way you'd have hoped, but it didn't work out in a way that you didn't expect and you hadn't planned for. And boy, it's sure better to walk away with a profit than with a loss, no matter what happens, right? So
Correct. But understand, losses are inevitable. It's inevitable. Literally, there's nothing you can do to prevent them that I know of, at least.
all right, everybody, that's the podcast for today. I appreciate you listening through to the end. It's Friday before Labor Day. U.S. Open tennis is on. I'm going to call it early today so I can go watch Tiafoe play. I'm going to do lots of grilling this weekend. We'll be back next week with more. And as we always say, keep your losses small and let your winners fly.
Reward, 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 reward.